with Michael Bishop of Van Dyke Mortgage. Why don't you tell a little bit about your experience, how many years you've been doing this, the company you work with?
Sure. I got jumped right into mortgage lending as soon as I got out of college. I had an aunt in the industry. She pretty much actively recruited me from a very young age. I've been with Van Dyke Mortgage for about 6 years on the origination side and 7 years in total, with kind of the initial learning phase of my career. So, yeah, about 7 years.
Awesome, man. And just kind of jumping straight into this, why don't you let people know that are not in the mortgage world what's happening right now?
Yeah, so I mean, right now, from what we're seeing, is we're seeing a lot of crazy volatility, and crazy up and down spikes with the market. Now, a lot of this, there's kind of like a three-part facet to it. A large part revolves around what's happened in the refi market recently. A lot has happened as a result of COVID-19 and the coronavirus, and that's influence in the market. And then the third piece is obviously the interaction that we've been seeing with the Fed and their influence in the market as a whole. So, I think we're going to continue to see some up and down trends, but there's been a lot of crazy rallies and corrections that hopefully here later today we'll be able to talk about. So, oh,
Bunch of crazy stuff right now going on, and I think yesterday we were talking a little bit about the sways and the dips. Can you elaborate a little bit more on that for like the average Joe to kind of understand what's happening?
yeah. So, we'll I didn't hear the first part of the question,
The
but
sways and the dips that's going on right now, how it's going up and down,
got
the waves.
Got you. So, if we were to look back at the market and kind of understand the entire interaction with it, you really kind of have to look at what the day one picture was. And I've kind of been studying this chart over here. Going back as early as maybe about, I would say, early mid-February, we went on a probably 3 to 3.5 week rally, one that we haven't seen for the likes of in quite some time. And basically, with this rally, we see over this period of time, on an average consumer, let's just say their interest rates were probably at the start of it anywhere from 4 and 3/8. They get down to about 2.75 to 2.875, 3%, somewhere in the low threes, on a 30-year mortgage. And if we're talking 10, 15, 20-year terms, it's not uncommon to see these people dip into the low twos, 2.25, 2 and 3/8, for their interest rates locked. But the market kind of quickly realized that we were getting there a little too quick, and there was a correction that took effect. Shortly after, so like right around March 9th, we start to see the correction that was kind of inevitably going to come. And over a 4-day window of time, we lose anywhere from 300 to 350 basis points. And, the biggest thing that we had lost is while the rally was taking effect and for about a 7-day window leading up into this correction, the mortgage industry and real estate as a whole saw, $1.5 trillion worth of interest rates locked to the likes that the secondary market and the servicers pipelines just couldn't feasibly manage. So the first thing that we see as a result of all of this is just the influx of new business from the refi sector as a whole, pretty much backlogged a lot of companies. Okay, so even though we're continuing on this rally for still a number of days afterwards, the rates started to slowly tick up. Okay, and then as soon as this correction took effect, rates just immediately, almost like instantaneously, just dropped considerably. So there's two parts to this up front in the beginning. The first part is the backlogging of the industry, okay? We're talking mortgage companies not having the support and the staff that they need in order to see these loans through. The second part is what's actually happening with the correction, okay? And this is when we're talking about the week that we just had. It was a week or two ago where we're really seeing, the Dow's just getting, pummeled. And we're talking, 5, 6,000, 7,000 points in Dow just lost it seems like in a blink of an eye. So originally when you're looking at everything, you got to kind of keep in mind this two-part equation, okay? And that's pretty much what we see as a result of kind of what's happened in the industry. So how does that play into leading us into the direction that we're now headed in and where we're at now in this constant swing of things? So what we're kind of seeing is the secondary market is not accurately reporting or depicting where the actual rates should theoretically be, okay? The industry is still very much backlogged. Appraisers are underwater. Mortgage companies, are kind of fighting right now to try to see these loans through, especially while the corona outbreak's going on. People are working from home. But basically, the servicers are looking at things and they're like, why should we be offering our typical rates when we have more than enough volume to choose from with what's currently out there that hasn't been, seen through, that hasn't closed yet? If we see the market corrects itself, and goes up, 100 points or 150 basis points, there's no real incentive for them to discount that coupon of putting the new rate sheets out there for these mortgage companies. That right there is primarily the first set of problems that we have, okay? So as a result of that, we're seeing a teeter-totter effect, or like I kind of described to you yesterday. Somebody in our company used to describe it as like the grandfather clock, where, on a day-to-day basis now, it seems like almost every other day we're seeing a correction for the better, and then we're seeing a correction for the worse, and then, a rally up, and then a correction for the worse. And basically what I am seeing is, it's investors knowing how the market behavior and how the market interaction is going to be behaving on a day-to-day basis, feeding off of that, shorting and buying, and they're making boatloads of money, but it's bringing instability and a lack of understanding and a fear into the market as to where exactly the direction this industry is going to head. Okay, that's the two-part equation. The second or the third aspect that we haven't talked about is what is going on from a global standpoint. How is the Fed's interaction involved with all of this corona madness and COVID-19 and things of that nature? And, as we saw, going back to the week where we really saw that huge market correction and a drop of, a large amount from the mortgage-backed security market, the Fed kind of realized, we are going to need to step into this, or we're going to be looking kind of back to the recent past at what we saw here in, 2008. So they made the decision at that point, as kind of the bond market was really rallying once the mortgage-backed securities were not doing so hot. They needed to inject a large amount of money back to support the lack of liquidity that was going on with the bond sector. So that's when we saw the news outbreak about them throwing, $1.5 trillion back into the market. And we're hearing talks of what they're looking at doing now, and they're looking at throwing another $500 billion in the treasuries and $200 billion into the mortgage-backed securities. And this is kind of a simple strategy that they used back in 2008 to kind of control and influence the direction of where rates are going to go, to help bring some stability to the market as they have control over. And it's definitely a certain aspect of quantitative easing. So that's one thing that we saw. The real big change of direction that we really needed to see, which did happen, was when the Fed cut the federal fund rate and took that down to zero. And that's what kind of started this whole teeter-totter effect. We were no longer now dropping out of the sky on this terrible correction off this very long 3-week rally. Now we're kind of back and forth. And that's still largely where we're at today. Fortunately, yesterday, we saw a nice correction for the better, of about 120 basis points that we gained. But just like we talked about, it's great that we have these improvements, but we're not actually seeing the true likes of what these improvements would otherwise be. Because again, the servicers are like, our pipelines are full. We don't know what we want to do as far as offering you what our typical rate sheet would typically be. So it's kind of a long-winded answer. There's a lot going on there, and we can kind of break down and dissect it piece by piece if we want.
Sure. Yeah, there's a couple things. We actually have a couple comments right now. A couple people that you and I both know. We have our friend Chucky Finster, aka Ari, says correction isn't even close to over, and I want to hear what your response is to that. I do want to let some dialogue from the audience go as well.
What did he say? Correction.
Ari says the correction isn't even close to over.
Correct. Yes, correct. And there's a lot of hesitation right now as to understanding the direction that it's going to go. So, from the market standpoint, the longer this COVID-19 thing sticks around, the more fear that kind of exists as to the global impact that we're going to see in the stock market. And there's certainly a lot of people, influencers and industry experts that are out there that are talking about we could see this correction continue to fall for an extended period of time. Now, at some point, and like we just talked about, the injection of the Fed, where do they play in all of this, and how does the other politics surrounding the matter at hand, how is that going to impact and influence maybe the safety nets that we're going to put in place to stop the market from necessarily just dropping out of the sky. So again, that's kind of why we're seeing this teeter-totter effect. We don't know the direction that it's going to head. We do think at some point, which is where all the signs are pointing to, the longer that we stay in this, the larger the likelihood that we're going to be in a recession, especially as we approach, election time. Historically speaking, those two kind of go hand in hand. So, there's still a lot of unknowns, but there is certainly a large argument out there, and it's definitely a possibility that this is not the end of the correction and that there's still a lot more room to go.
Yeah, and I want to talk about a couple terms just so people can understand. I want to let Michael answer this. Why don't you elaborate a little more on what basis points are and how they play into the industry for the average person?
Sure. So when we're looking at a pricing sheet, most people don't realize that any interest rate is available to a client. Okay, we're talking rates from the 5s to the 2s. And you pretty much have the pick of the litter as far as where you want your interest rate to be. They just all come at a different cost. Okay, so the first term that we're going to throw out there in the lending industry is what's known as par pricing. Par pricing is basically the point at which your pricing is 100% flat, meaning you're not paying any extra money to get a reduction in your rate, but you're not gaining any money from the lender for taking a higher rate. Okay. Basis points is basically the intervals that we use to determine the talks of the pricing. It's a percentage of the loan amount. It is 0.01% of pricing. So when we're talking about 100 basis points, that's 1 full point. So that would be taking a par pricing of 100% and dropping it down to 99%. Now, 1 point in realistic interest rate terms, it's going to vary depending on credit score and the type of loan term and different things like that. But 1 full point, we're talking anywhere from maybe 3/8% to 0.5% in interest rates is 1 full point. So 1 basis point is 1/100th, essentially, of that.
Gotcha. And kind of going back to the whole answer in a whole, what's the best method, I guess we could say, as a consumer, as a loan officer, just speaking generally, and then if you want to speak more specific, how we all can survive this right now?
So, from a loan originator standpoint, the best way to survive this is understanding that there's two parts to this business. Okay. You're going to have your buy side and your purchase side for people that are needing to buy, wanting to buy, needing to get out of the rental cycle, where there is going to still be some sort of common knowledge that, even if rates continue to push into the fours or even approaches the five territory, if you ever go back and look at the historical interest rates, you'll still see that that is, historically speaking, still very, very low. Now, unfortunately, we've been spoiled in recent years with getting rates down, into the low threes, fours, that a lot of people think that that is now the standard. Okay. So the buy side is going to remain the buy side, the purchase side of this business. What are we doing about refis? And that right now is where a lot of loan originators are just clueless as to what they should be focusing on intentionally with their business. And there's a couple of things that they need to be doing. One, again, there is still a lot of doubt and hesitation and uncertainty as to the direction that the market's going to head there, because there just is so many facets to this larger picture equation that's going on. We do hear that at some point the correction back up to where interest rate pricings are again coming down is certainly a possibility, but we don't think it's probably going to take effect or show up for, it could be a couple of weeks before we kind of get back on that same rally that we were on originally. So what we're being told, which, I think is great advice to anybody, is the talks and the conversations with the people that you had that were possibly interested in doing refinances before the rate spikes really took effect. If you were unable to get them locked in that period of time where rates were really, really low, it's important to still keep those, keep the communication, keep that relationship there back and forth, because at the flip of a switch, in a very small, brief window, we could see, again, crazy volatility with another quick rally up, which opens the door for relocking those people that maybe missed out of the first. Okay. And when we look at where we're at currently versus where we'll be in a few weeks, from a servicing standpoint, a lot of these loans, this $1 trillion influx of interest rates that were recently locked for refis, those are going to be pushed out. They're going to be done. They're going to be closed. They're going to be pushed through. And there's going to be servicers that are going to be hungry again for taking on more deals. Well, they will adjust their pricing sheets accordingly. So if kind of the stars align where the market rallies correctly, the business kind of outgoes and we close them, we could see, again, small windows of timing gaps where the refis will make sense again to get back into those low to mid three territory for a lot of people. And, it wasn't too long ago, back in 2019 or 2018, rates were in the, mid fives or high fours. So, if someone was locking in at 3.5, 3.375, that's a tremendous amount of money that they're going to be saving, just depending on how they set up and structure their refi.
Awesome. I'm going to take this time just to say hello to some people. We got a bunch of people that are on here right now. A couple people calling. Earl, what's happening? Edgar, what's up? Ari, what's up? Ashley. Yep, Ashley just commented. Great advice for LOs and consumers. Thanks. Awesome. Thanks for watching, Ashley. Ashley's actually a loan originator in Philadelphia. Ryan Wisniewski, what's happening, man? Nick Horton, Joey Gagnon, Chris Waterhouse, Malaya Lockhart, Leonard Keith, what's going on? Cameron Crane, what's happening? My guy Low Paul down here in Naples, what's happening? Jamie, we got our buddy Terry, who's also in the mortgage world now as well. So kind of going into this more what we can do right now. And for anyone that's watching, me and Michael, we talked a little bit yesterday about the opportunities, and don't forget the opportunities. What kind of conversations should we be having with our realtors right now?
It is something right now where while people are kind of in this quarantine and lockdown in their houses and stuff, it really is a great time for loan originators and industry professionals to really be dialing in and figuring out the relationships, the organic relationships they want to be having um, with and who they want to align their business with going forward. I mean, if you're not picking up the phone, talking to them, maintaining this relationship, and giving them at least a couple of touches throughout the week, you know, we could see to some extent a shift in how our industry operates. You know, this Corona thing can really open the eyes up for a lot of companies of, you know, are we going to be working from home remotely? Is there going to be a certain aspect of that? In real estate, is this something that can be virtualized? You know, can they do virtual showings? You know, the problem is there is the potential for a lot of belly to belly aspects of this relationship and this business to possibly go out the door, the face to face, the in person. And if we don't maintain the relationships with the people that we're currently aligned with in this business, you know, there's going to be opportunities for a lot of people to come in and swoop that up. So, you know, I'd advise everyone to run through their list of who they've worked with in the past, keep an A, B, and a C list, really manifest on those A's, and, you know, stay in touch with the B's, and, you know, occasionally reach out to the people that are on your C list, and, you know, try to dial it in right now. Get in good communication with everybody. It's a great time to just have simple conversations. Hey, just wanted to check in on you. Just wanted to make sure, you know, you and your family's safe. Were you able to stock up on some food? Let me know if there's anything that I can do to help you during this weird time. You know, if you need me to reach out to anybody, I'm certainly available still. You know, simple touches can go a long way.
Awesome, awesome. Yeah, that's what's awesome. Anyone that has never done like a Facebook Live with anyone you know or any of your clients or prospects, these kind of things will be beneficial for both parties because, as Michael says, that it gives me an idea, and you know, anyone that just listened to what Michael said about A, B, or C lists and is too busy to make the phone calls, I'm going to plug my service, have my team make the phone calls for you because you're too busy with your refis,
Yep.
and then we can reach out to your realtor list for you and make the phone calls. So just to plug my service and also to let people know why doing Facebook Lives with people and video is the future. That being said, you know, we also talked about the reality of real estate delays, and I wanted to let you talk about that a little bit more in depth.
And this is a very big one because just like what we're seeing with market direction and changes, we're also seeing changes in realistically what real estate's going to look like for the coming weeks, possibly even into the month. So the first big change that we're really seeing right now is the impact that the refis have had on title and appraisals. Okay, the biggest one being the appraisers. Okay, typically speaking, the way an appraisal is set up is when the mortgage company places the order for an appraisal, we usually bid out a certain dollar amount to a local pool of appraisers that would operate in a geographic area of where the home is located. And it's up to them to kind of bid and accept that they are okay with the dollar amount that it's been bidded for, and that B, they can get us the appraisal report finalized and back to us within a certain time frame. Well, what we're seeing right now is every appraiser is basically declining our initial request for our bids from what has been standardized for, you know, the last couple of years. And they are increasing the amount of money for what the appraisal will cost, and they are increasing the duration of time that they have to get us the report back to our appraisal management service department. So that's certainly going to cause a tremendous amount of delays, because what we're seeing is instead of appraisals taking anywhere from, you know, 6 to 7 or 8 days to get back in our pipeline, we're talking 14, 15, 16 days. Okay. So that's delay number one. Delay number two is kind of more of a what if of what's to come. Yesterday, we saw, I think it was 3 or 4 states already go into lockdown. Okay. Pennsylvania, Texas, California, and then I think they were talking about New York. I don't think New York did it just yet, but they're pretty close because I think they got like 8,000 cases of COVID, which is like half of the nation's total cases or something like that. We want to talk about what's to happen if a lot of these government offices shut down, or if even just partly some of them shut down. So, in the past for different things that we've seen, like if the Social Security office shuts down, how's that going to have an impact? Anyone that's collecting basically Social Security disability for income, if we're not able to get these letters or these reports back, if our buyers didn't hang on to their slips that they got at the start of the year, that's going to be delay number one, because we're not going to be able to document income.
Yep.
A bigger one would be the IRS offices. The IRS offices are closed down. We're not going to be able to submit tax returns for buyers that maybe haven't filed taxes yet, need to use 2019 income. We're not going to be able to get tax transcripts back for any government loans, which will be a huge delay and pretty much stalemate any of them that are requiring transcripts. And if we have people that are waiting on tax refunds in order to utilize that money in a real estate transaction, that's also going to cause a huge delay. And then you also have different government agencies and organizations that are actually in real estate in general. Fannie Mae, they set the guidelines. If we're not able to assign FHA case number assignments, that's going to be a big impact. So that whole side is going to have a direct impact into the flow and the streamlining of the actual process of getting the loan from the mortgage provider. But then lastly, there's the whole flip side of what happens if all the government office closes and we're not able to actually record these loans. Okay. You can close out a title company, get all the paperwork done, but what happens if we can't record because everybody's still on lockdown? That's another big concern that we're having right now. Or banking institutions. What happens if I can't send my wire? So, yeah, it's certainly scary. It is very scary. We could also continue to see people that maybe are in the process of getting a loan right now with, this whole quarantine stuff. People are losing their jobs. That's going to have an impact. And, if you got multiple borrowers on a loan and somebody's, working childcare, who's going to drop their kid off at a childcare center with 30 other kids? I had that situation come up right now. So this one lady's out of work temporarily until the childcare center opens back up because,
Yep.
It's crazy. It's crazy.
Yep. Cool.
So,
Awesome, man. And I appreciate this. This has been great. Thank you again. And just real quick, anyone that wants to work with you or get in touch with you, what's the best way for them to do that?
yeah, I mean, I'm here to help anybody in the industry as well as anyone that's possibly needing any financial lending advice or, real estate financing as well. They can call me directly on my cell, 813-503-1819, or you can call us over at our team office, which is 727-214-6400. Just ask for Mike. If you want to shoot me an email, if you're more of a keyboard warrior, you can email me at M for Michael Bishop, like a chess piece, at VanDykeMortgage.com. And like I said, I know, James, you work with a lot of realtors and other loan originators as a whole. There's definitely a certain creativity piece to sometimes getting these loans through. So I do want to say, I come from a service-based lender. If you are struggling with a loan, you don't know how to get something done, or if your back's up against the wall and you just need some financial advice, you want to bounce a second opinion off somebody, don't hesitate to give me a call. Whether I'm doing the deal or not, I'm still here to help anyone that possibly needs my assistance. So thanks, James.
Awesome, man. I appreciate that. I'm going to end the live right now for everyone, but I'm going to stay on with you for like another minute. But everyone that's watched, thanks for watching. And thank Michael for his time, of course.
Thanks, everybody.
That was great, man. I appreciate that. That's a lot. We got a lot of people hopped on that were either lenders or this or that. And
I didn't have the same flow that I had in describing the pricing thing. Yesterday was so fluid, and it was
same here.
Beautiful. And I was like, fuck, how do I get back to this?
Yeah.
I was like, I don't know
I
if it
think it's
was
like energy. I think it's like energy. Like I was tired as shit coming on this, and I was
yeah.
like,
I
and
think
I
it
was
could be that. It was either
yeah,
that or it was I just it was like when
did
you're sharing
good.
it was like when you're sharing in a meeting and you have like this perfectly concocted share about like
Yeah,
what you're gonna say, how it's gonna transition, and I did it beautifully yesterday. And I wasn't sure if it was because I just had our companies talk about where pricing and secondary and interest rates and all that's at, that it was so top of mind. But yeah, it definitely took me a little bit to get into
yeah, you
the
did
direction
fine.
I wanted to go with it. But
Yeah, you did
oh, man,
fine, man. I appreciate it once again, man. This is great.
no worries. And if you ever want to just do a market recap, 2, 3 weeks from now, where are we at now? Let me know.
Yep, I definitely will probably ask you to do that. That's
Sure.
awesome.
Cool, man.
Cool. All
Well,
right, bro.
hey, bud. Hope you enjoy your day. If you got any other questions, give me a shout. All right.
We'll do, man. Enjoy your Saturday.
Take care. Bye.